But just come back. एक काम पता तो आपको डालो.
Jatin ji, please keep yourself on mute. Last time also I muted you.
Hello. Bhave sir, I have given you 3 names for co-hosting.
कितने दिन के? एक हफ्ते।
संदीप जी, मेरा स्क्रीन दिख रहा है ना?
Yes. Where have you given them, Nitin?
On your WhatsApp, personal WhatsApp.
Okay, okay.
तो क्या ये लोग क्या
Saili, you are there, no? Saili Deshkar.
Yes, sir, I'm there.
So we will be starting with you directly.
Okay, at 6:30, na?
Yeah, the moment Mr. Sanjeev joins,
Okay.
we'll
Okay.
start, and then after his address, we'll have the presentation by Mr. Bhave.
Okay. Okay.
Good evening, Bhave sir.
Good evening, Srinivas ji.
Good evening. Good evening.
Pleasure to see you.
Good to see you too.
Asmita, have you joined? Nitin, has Asmita joined?
But she has not joined as yet. I don't
Okay.
see her.
Okay, okay.
But I think she will join.
All right. We'll have to keep the track, no, to make her go.
Yeah.
That's why.
I was just send her a message. Asmita, good evening. Join केला इसका?
Aspita joined, right?
ट्रॅफिक मध्ये अडकली आहेस. ओके. हो ठीक आहे, शक्यतोवर ट्राय कर, म्हणजे मग नाही तर मोबाईल वरून join कर. ठीक आहे. तुझं याला वेळ आहे अजून, 7 वाजता तुझं असेल.
Nitin, go on mute.
या.
Hello? Hello?
हा बोल. नाही करू दे त्याला सुरू. ते आले का? नाही हरकत नाही तशी करायची. व्हॉट एव्हर म्हणजे
When today,
चालेल.
no, I'm not received it. Yeah, got it. Yeah. Correct. Right. Hmm.
Go back and change these things. So instead of sending it.
Sanjeev Singhal, sir, have you joined? Sorry, our chief guest is joining in just 1 minute.
Okay, welcome. Has he joined?
No, he
He has joined. He has joined. I
He has
think you
joined.
can get started.
Okay. So good evening and welcome to all. Against our tradition of starting the opening remarks by President Ram Mohan Bhave, we are now starting straight away with the introduction of chief guest and the chief guest address. Welcome, Mr. Sanjeev ji, to this program.
A very good evening.
And, yeah, good
Very
evening, sir.
to all. Very good
Yeah.
evening.
So since you have to go, we are starting with your intro, and then you can speak, and then you can log out.
Sure, sir.
Since you
Sure.
have some pre-planned program.
Sure.
Yeah, thank you. Saili, you can start with the introduction of the chief.
Okay, sir. Good evening, everyone. I am CA Saili Deshkar. On behalf of the Association of Valuation Professionals, I welcome you all to today's webinar. We have among us Dr. Sanjeev Kumar Singhal sir as a chief guest. He is a chartered accountant and a PhD in the subject of international finance from the Delhi University. His areas of expertise include IFRS, accounting standards, revised Schedule 6, and XBRL reporting. Sir has a rich experience of over 20 years in audit practice, industry, research, and academics. A partner in SR Batley and Company since 2015, he heads the Financial Accounting Advisory Services and audit practice, which includes assurance, internal control over financial reporting, accounting transformation for governments, and learning solutions. In industry, he has worked in multi-sectors, including pharma, healthcare, media, financial services, and has headed finance function, including management assurance, risk management, mergers and acquisitions, treasury, budgeting, forecasting, financial management. He has also supervised accounts, MIS, credit rating, and IFRS implementation process at several organizations. He has created business models, developed and executed growth strategies, and established sustainable processes to fill structural gaps. He has experience in financial reporting under 7 different accounting gaps, like the Indian GAAP, US GAAP, IFRS, and so on. Name a few of the brands he has worked with. They include Sigby, Cyber Media India Limited, Religare Enterprises Limited, Jubilant Life Sciences Limited, etc. In addition to his experience in audit practice and industry, he has also significantly contributed to the field of academics. He was an associate professor at the Ford School of Management and the Indraprastha University, New Delhi. He has addressed more than 250 seminars on accounting standards, Ind AS, IFRS, International Public Sector Accounting Standards, Revised Schedule 6, and so on, not only in India, but also in foreign countries. While he was working with Jubilant Life Sciences, he was heading the accounting centers of excellence. These centers catered to the need for solutions to complex accounting situations, proactive training to account, and thus was involved in detailed interaction with the International Accounting Standards Board, Confederation of Indian Industry, Federation of Indian Chambers of Commerce and Industry.
I request all the audience go on mute, and I request the host that those who do not go on mute, they will have to be removed. Everybody, please go on mute. This is the last time I'm telling. Saili, you remove the presentation, then we can find out who are not on mute and make them mute. There are still people talking. Please go on mute. Host, otherwise remove them, please.
No, there is some background noise coming from our chief guest's office only.
Yeah, I'm sorry. Actually, I'm not able to mute myself. It is not giving me an option. If you can.
DDM కూడా ఓకే అన్నా అండి, ఇది వచ్చేసి అయిపోతుంది. DDM తో కూడా డిస్కస్ చేసాం మేము. చెప్పు.
Yes, Saili, you can go ahead now.
Yeah. Okay. Apart from this, he has authored several books, including Practice Manual on Revised Schedule 6 and Auditor's Report, A Practical Guide to the Revised Schedule 6, Practical Guide to Ind AS, and Practical Guide to Depreciation. Apart from this, he has also immensely contributed to the development of CA profession. He was a special invitee with the Board of Studies and was involved in the development of study material for the new Chartered Accountancy course. Special invitee on Ind AS Implementation Committee of ICAI and has contributed towards the background material on several Ind AS. Nominee of CII on Auditing and Assurance Standards Board of ICAI and acted as a resource person for developing several guidance notes on auditing. Special invitee for various ICAI committees like Research Committee, Corporate Laws Committee, and Ind AS Technical Facilitation Group. He was a member of CII and National Financial Reporting Committee as well. Sir, it was indeed a challenge to summarize your achievements and experience so as to be able to narrate it in such a short time span. It is our honor to have you today with us, and I'm sure each one of us is eager to hear from you. So I would request you to say a few words, sir.
Thanks, Saili. Over to you, Single, sir. You have to
Very
unmute.
good
Yeah.
evening. Very good evening to you all.
Good evening.
Thanks, Ali, for giving such a nice introduction. In fact, some of the things you mentioned, I'm just wondering from where you picked up, like the 7 gaps in Jubilant. I used to write long ago, when I was in Jubilant. So I really admire that from where you have picked up some of the things. Nowadays, in last few years, I'm not writing in my profile. So you must have done a thorough research, just like what is required in the merger and acquisitions and the valuations. And Sandeep Agarwal ji, thanks for inviting me. There was some mix-up, but then I thought it is my duty that I'm present for at least 5-7 minutes. Actually, our central council elections are going on, so we have to do an extensive outreach.
You are number one in CC also.
Yeah,
you are number one champion in CC also. We have to see there.
Sir. And that is why some background noise is also there, which is unavoidable at my part. But as far as this topic is concerned, it's a very relevant topic. Valuations are the backbone of any deal, and particularly in merger and acquisitions. And valuation comprises, a very wide spectrum of professionals, whether it is chartered accountants or the valuers or the tax professionals. Some of the valuations that we see today are mind-boggling, and we simply wonder that nowadays there is a saying that the Domino's pizza, which is being just carried by Zomato on the motorbikes which are manufactured by Hero. So Zomato has a better valuation than Domino's, Domino's as well as Hero. I personally worked in Domino's as a part of Jubilant Life Sciences. So these valuations are really mind-boggling. And then one needs to understand the rationale behind this. And at the same time, as a professional, it is our duty that the valuations are realistic. So obviously, different types of professionals will play a different role. For example, as chartered accountants, we need to see whether the fundamental assumptions which are there. As a statutory auditor also, I'll be required to look into it, whether the fundamental accounting assumptions are proper. As a tax professional, one has to see whether it complies with the letter and spirit of the law of the land. While in letter it may comply, whether it complies with the spirit of the law also. And of course, as valuers, we need to see that although we can say that why one should apply a principle of conservatism, don't apply principle of conservatism, but at least apply principle of prudence, because ultimately the poor investors are going to rely on these valuations, are going to rely on the auditors, are going to rely, even the courts are going to rely on the professional. So this topic assumes importance. There may be limited number of people who may be interested in it, but it's a very, 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 very relevant topic. I really compliment Brahma ji, Sandeep ji, Chali ji, and all the organizers of this program, particularly the Association of Valuation Professionals. Honestly, I mean, before I received the invitation, I was not knowing much about it, but particularly Rammohan Bhave ji, the kind of topic which has been chosen. And when you're focusing on valuation, this is really great. So many chartered accountants are associated with this program. And as I said, the kind of R&D which was done for my introduction also was really mind-boggling, was really amazing. I really wish this program the best of success. And again, my apology for not being able to give due time, but I thought that I must make it. And I will be available. Maybe just give me some time. 3rd and 4th December our elections, and those who are from the northern region, I would request all of you also for your support for the Central Council. Presently, I am a Vice Chairman of the Accounting Standard Board and a Chairman of the Sustainability Reporting Standard Board and Chairman of the Committee for Member in Practice and Vice Chairman of the Committee for Members in Entrepreneurship and Public Service. So together, we are trying to shape up our profession, work to the best of our abilities, and we'll continue to work to the best of our ability. We would request for your support. And once again, I would like to thank the organizer and wish the program a grand success. Thank you very much.
Sir, thank you very much for your very concise and very to the point address to our valuation this webinar on mergers and amalgamations. So thank you very much. I hope we have been able to satisfy you as far as the time is concerned.
No, absolutely, sir, absolutely. And I'm saying my apology as far as the accounting perspective is concerned. All of us know accounting standard 14 and in India 103 are the relevant standard for business combination. But people go to the court and take deviations from the standard. But again, reporting is required. And now in Schedule 3 also we have made it mandatory. If there is a departure, then those departures needs to be disclosed.
Correct, sir. While we would love it if you stayed back for the presentation by Krupali Gandhi. But unfortunately, since you have to leave, we have to allow that.
Yes, sir. Probably I will have a look at the recording.
So on behalf of the association, I thank you very much for coming and gracing the occasion and addressing us briefly. So thank you very much.
Thank you, sir. Thank you very much.
Over to Sir Ram Mohan Bhave, sir. Now the stage is yours for your remarks.
Yeah, thank you, Sanjeev Singhal, sir. It's our honor that you could spare some time, and I'm sure the work you are doing will go a long way to help the nation as well as the community, the professional community, which is on the valuation focus. As a founder president of Association of Valuation Profession, it is my privilege to have a chat with you. And as you can see, we have already touched the Zoom limit of 100. If any of your friends are missing it, then feel free to go through the YouTube link, which has been posted on the relevant WhatsApp group. Okay. So we may not be able to satisfy everybody on the Zoom link, but yes, the YouTube streaming has been already done and it has started also. People who are on Zoom link, they are welcome to start posting their queries in the chat mode for Krupali Gandhi madam, because today's subject is quite hot. Reason being that we have mergers and acquisition as a very hot topic. In fact, if one has to take the most creative work, I would say unstructured and creative work where there is no monotonous. Yes, that is nothing but M&A work. And a valuer has a major role to play in M&A, not only just valuation, but also having a lot of chances of participating in negotiations, participating into deal, participating into making teasers, etc., etc. And here we luckily have, she will be introduced in detail by others, but we luckily have Krupali Gandhi, a star whom I came across this. She will be focusing on purchase price allocation. Please understand purchase price allocation. So if you are expecting everything on an M&A, please invite her for 10 days at least. But right now we are talking about only purchase price allocation because the topic itself is so vast, and she is ex-Grant Thornton as well. But our people have already done Google search on her in detail. So she will know some surprises like Singhal sir got it. I also actually know this girl from, girl means sorry. The chief speaker today is very difficult to, call her madam for me at this age. But she stays very nearby, and the day I found her, that day itself, I decided that Krupali has to be our speaker. Okay, because the type of knowledge she has is huge. Now, I am sure once again, Nitin and my colleague Sandeep would like to invite Krupali ji because she is the startup champion also. So I am giving her an advance warning that we will bother you again. She currently is the CEO of a startup company and doing wonders. While her introduction will be focused, I want to appeal all of you to become the member of Association of Professional Valuers. The membership is open for everybody who has an interest in valuation professional. So you need not be CA, you need not be CMA, you need not be company secretary. You can be an engineer also, you can be a doctor also, you can be anybody. You can be a student, you can be semi-qualified, you can be a simple graduate. But the idea is that to spread the valuation knowledge. Mr. Sayedji, how to become a member? We have ease of taking membership. What is called as ease of taking membership? Simply pay 5,000 rupees by way of Google Pay to the number which I am giving you, and that's all you're done. Okay. And if you don't have Google Pay, then you have a UPI ID. I'm putting it in the chat mode, both the Google Pay number as well as the UPI ID. Okay. I mean, to be honest, we have made the process very easy. There is a form, then you have to give PAN, Aadhaar, and passport size photo, everything by WhatsApp to the same number. Is it one-time payment, Harinarayanji? Yes, one-time, lifetime, no annual fees. We have mechanized all the operations. If you want any hard copy, then the cost will come. Don't ask anything by hard copy. All right. And then we also have happy to announce this on behalf of a session held jointly by IIV and AVP. And IIV is, we are in tie-up with IIV, who is because of which our members who are registered valuers can get CEP hours credit. A process for that is additional. There is an additional fee of 1,500 plus GST per annum to be posted to IIV. Okay, so literally, and you will in a year can hear 48 webinars. My colleague Sandeep is doing sixers after sixers by getting huge number of people. Those who are members, registered valuer member, and wanting to have CP hours credit, provided they have paid for, then they should put their numbers in the chat mode. AVP charges only lifetime fee. We work on corpus model. We don't work on annual fees model. So once you pay 5,000, and that's very minimal, so you have nothing to worry. And there are three major activities we do to start with. One, having webinars almost every week. Two, having the newsletter published, e-newsletter published every month with quality articles. And the article writers are also of a very high proficiency. The third thing which we are doing is we are studying all the international valuation standards by forming study groups. And then once we have those study groups completing their studies, then we are going to have them submitted to IBBI, who will be considering them for the purpose of the valuation standards. Now the question is how it will help, because we want to make valuation professional clean and transparent right from beginning, because we all know that our country has to be made clean in terms of financial issues also. And a lot of work has been being done nowadays. Reducing NPAs is one of the classical role which IBBI expects to pay via valuation and IP profession. The process of taking life membership, as I said, is very easy. Pay 5,000 by Google Pay or through UPI ID. There are no annual fees, there are no recurring fees, nothing. It's a national society. And I can tell you, we already have 139 members even before the society is getting registered. So it's a personal trust on which I think people are joining us, which is a very welcome sign. And the number of members, they are from 34 cities. And not only that, they are from 3 countries: Melbourne, London, and Dubai. That is UK, Australia, and Dubai. We already have members. We are in the process of tie-up with the valuation bodies in USA, Singapore. Our friend, our colleague Ravi Chandran is working on it. Nitin Brahma is the resource committee head, while Sandeep Agarwal is the head of professional development committee, and they are doing a wonderful job. Because of that, a lot of programs are happening, and we are getting the knowledge treats one after other. Having said that, I am welcoming one special member today and then completing my discussion. Balakrishnan ji, thank you. After hearing Krupali Gandhi's name, you have decided to join this webinar from Nigeria. So we welcome you, and we are proud of you that we have such speakers of Krupali Gandhi's level who like to be attended by international circuits from different countries also. And we already have, of course, few people joined from Canada. but they had been joining before also. Now we have somebody from Nigeria also. That will show you the stature of Krupaliji and her knowledge which has been getting circulated. And today it's our honor that Krupaliji agreed to come. And then I know how her schedule is tight. So luckily I could pursue and push her. It just took me 4 months to get her date. Okay, not much. So with that, again welcoming all of you to become the member of Association of Valuation Professionals. I hand over to my colleagues. Thank you.
Yeah, thank you very much, Bhave sir, for your address, presidential address. Now, before we move ahead to the main topic, the presentation by Krupali Gandhi, there is since this is a CEP webinar jointly organized by IIV, RVF and EVP, we have a small presentation for you, which encompasses the presentation for APV as well as for IIV, RVF. Now, the IIV, RVF, my colleague from IIV, RVF, she will be making the presentation on behalf of IIV, and I will be showing you some slides for APV. So as I said, this is the webinar organized by IIV, RVF and our AVP, Association of Valuation Professionals. And the topic is very, very interesting topic of valuation under mergers and amalgamations, purchase price allocation. Whereas Mr. Bhave has rightly said that Krupali Gandhi is an expert in mergers and acquisitions. Then this agenda was flashing all the time on your screen, so I won't go much into that. Now, this is IIV India Registered Valuers Foundation, RVO. There is a small one-page presentation. So Aishwarya Darode, can you make available yourself and make the presentation? Aishwarya?
Has she been co-host?
No, but she has to only speak, no, see this and speak.
Okay.
Yeah, good evening, everyone. I, Aishwarya Darode, welcome you all on behalf of IIV India Registered Valuers Foundation. As you all know that IIV RVF is the second largest valuers organization. We have more about 5,000 practicing valuers across India as well as abroad. We also run the 50 hours of training course for IBBI for all the class of assets. About thousands of members we have trained for this course, and 140 members are registered with IBBI successfully. So I just welcome everyone and thank you.
Thank you, Aishwarya. Moving ahead, Mr. Bhave has already dealt with this subject of the life membership. So this is just a refresher to that you have to pay only 5,000 only one time.
Your screen is not visible, Nitin. The screen is not showing.
Sorry, screen is not visible.
Yeah.
Okay. I'll make it visible. Is it visible now?
Yes. Oh.
Okay. So this is just a refresher. Now, again, Mr. Bhave has already explained why we should join, but I am just saying again that what AVP does is there are free webinars, at least 2 each month. There are 48, actually it is revised to 4 per month. So there are 48 webinars that will be happening. And what we do is mentoring the newly registered valuers, mentoring the students. It's not required that you need to be a valuer to become a member of this organization or association. You can be a student also. Then there are monthly e-newsletters for sharing knowledge. So those articles in that monthly e-newsletter are written by our own members. Even outsiders are also welcome to contribute and write articles in that. But predominantly our members' writing prowess or authoring prowess is unfolded through these newsletters. And this is a national and international level going to be a society very soon. And we do in-depth study of the international valuation standards, which is required because there are a lot of revisions, etc., that we are going to recommend to IBBI. Then we can participate in various activities because there are various committees, those are formed. So you can be a part as a member of these various committees. Then you can also attend international webinars at a discounted price. Because if you want to be recognized internationally, then you can attend the webinars. There are study groups which enrich our knowledge, and then knowledge sharing events have already happened. There are a lot of knowledge sharing events through the webinars, those we have held. And as I said earlier, or as was presented by IIB RBF, we have a tie-up with them for CEPRs to be granted to the registered valuers. Going next is, as Mr. Bhave mentioned, that Sandeep Agrawal is hitting success after success. So these are some of the success which he will be hitting in future. He has already hit a lot of success. Now he will definitely score 1,603 runs in 50 overs. So these are the, this is the gist of the webinar. Those will be happening.
Video bande kya? Stop video sir.
Hello? Yes? So I have a list of webinars up to 10th December, but to give you the good news that we have already lined up webinars till 24th of June 2022. And for sheer lack of time and lack of space here, I have not been able to show them all here. So, but this can actually give you the kind of depth we are working on those knowledge webinars. And this is a great advantage to join the association for this reason, because you will be very rich if you attend so many webinars. Now, these are the contact numbers. You can always contact these people, so you can note down. Or maybe these are there available in the membership later, which we are giving to all, or we are putting on all the social media platforms. So thank you very much on behalf of AVP and IIB RVF for joining this webinar. And now I'll hand over the session to my colleague Asmita Phadke to take you through and introduce Krupali Gandhi. And then she can hand it over to Krupali Gandhi from her.
Smitaji, before you start, a one-liner that yes, for sir. All the members, please look into the Zoom chat mode. I have posted all the past newsletter. Chintan Mehtaji, all the 5 past newsletters published having very quality articles have been attached in the Zoom chat. And I am also sending you in 5 minutes time the paper, which is a form to be filled up, Word file, no signature required, and to be posted on the phone number given if you want to become a life member, so that you will have ease of taking membership here itself. Over to you, Asmita.
Yes. Yes, good evening to all VP and all the participants of today's webinar. I am Asmita. I thank AVP for arranging these platforms for career seekers like us. I would like to introduce now our today's speaker, CA Krupali Gandhi, on today's topic of M&A valuation, purchase price allocation. Krupali is a chartered accountant and CFA pass out and comes with more than 5 years of combined experience in consultancy as well as industry. She has been a part of major M&A and restructuring assignments involving public companies and brings rich knowledge in the field of valuations. Presently, she is the head of finance at Bombay Hemp Company, India's premier hemp-based wellness startup. Her passion includes reading, painting, and teaching. Now, I would request CA Krupali to please share her knowledge with all of us on purchase price allocation. Thank you.
Thank you, Asmita, for the generous introduction. Good evening, one and all. I would like to start my my speech by thanking Mr. Ram Mohan Bhave Sarji for giving me the opportunity of speaking at such a large forum. I understand there are international participants and a lot of experienced professionals who have also logged in just for the webinar on PPA. So thank you so much for giving me this platform, Bhave sir. May I request the option to share my screen? And
Yeah,
then
you
we
have
can
already
start.
been made a co-host, so you can
Right.
straight away
I'll just,
start sharing.
yeah, if you can allow me a moment, I'll just start. I hope my screen
Yeah,
is
we can
visible
see.
to one
Yeah,
and
yeah.
all. How
Yes.
we'll progress with this seminar is I'll first introduce the topic, because this is fairly a complex topic. It is not something that you come across even in regular valuation field also. So I would like to take you through the PPA concept first, and then we can invite or address all the queries that are there. So let's start. Now, what exactly is purchase price allocation? I've started from very basic of what exactly do we mean by PPA or purchase price allocation. It is simply the process of assigning fair value of all the assets and liabilities that are acquired in a business combination. Now, whenever a company acquires any target company, there are a lot of assets that are there on the balance sheet of the target company. But when we talk about PPA, we are not talking about the book value, but the fair value of all those assets, and not only assets, but also liabilities that may be, hanging on the head of the management who is taking over such a target. So when we talk about PPA, we are talking about fair valuation and not just, book value shifting from one company to another, right? Now, let me just quickly introduce the concept of purchase consideration, goodwill, and net assets taken over. Generally, whenever you see an acquisition, if the purchase consideration is 100, usually we can identify the net assets up to tangible assets roughly up to say 60, 70, in some cases as low as 20 or 30% when you talk about IT companies or even pharma companies who are loaded with a lot of IPs. So when we talk about purchase consideration, not all the purchase consideration can be allocated to tangible assets. What happens is the balance that is there. So for example, company A purchased company B for 100 rupees, and if the identified net assets taken over are of 80 rupees, the balance 20, which is not identified anywhere, is usually accounted as goodwill. At least from academic point of view, to keep things simple, this is how we are taught the basic concept of allocation of purchase price or purchase consideration. Now, the opposite can happen, which is very, very rare, but there are cases of bargain purchase, as we call it, where you have paid only 80 rupees, the acquirer has paid only 80 rupees and probably received net assets worth 100 rupees. Now, the balance of 20 in this case is the opposite, or on the credit side, which is the capital reserve that has to be created. This is very, very rare. Only in case of rare bargain purchases can you see such a situation. But our PPA is mostly based on this premise. Going forward, now what exactly is PPA? Broadly speaking, this is how we can bifurcate the topic for an overview. Now, why do we perform PPA in the first place? What is the value, or what are we trying to value exactly? Because as I mentioned, academically it was always taught that the differential is goodwill or capital reserve, but practically when actual acquisitions happen, the companies do not recognize balance as only goodwill. You actually identify what are the intangible assets that an acquirer is paying for, because an acquirer who is paying crores of rupees over and above what can be identified directly as net assets is not going to simply pay such an excess amount for goodwill itself. There are intangible assets that can be identified and the value can be attributed to. So what exactly are we trying to value even when we say just intangibles? And how do we actually perform PPA valuation? Because how do you value intangibles? It's so difficult to even imagine valuation of intangible assets, something you cannot see, something you do not have a document for. How do you value it? So let's go about this. Now, major reasons why we conduct a PPA exercise usually is, one, because the accounting standards require this. Second is the tax benefits, because even though there are companies for whom accounting standards do not mandate PPA exercise, they would still want to go ahead and do the exercise and identify intangible assets, only because there are a lot of tax benefits also. What happens is, when you identify an intangible asset and bring it on your, record it on your balance sheet, you get to amortize. Under most of the tax laws, you get to amortize these on year basis, right? Whereas goodwill is simply tested for impairment on year basis. Now, what happens is, under tax structure, when you are amortizing these intangibles, there's no real outflow of cash, but you get benefit under taxation. So for avoiding the excess tax outflow and better planning your tax outflows, this is something that generally the acquirers end up doing. And third is, of course, for corporate governance, there's so much importance on transparency and legacy. Even the companies that are unlisted private companies, there are a lot of startups who would want to establish themselves as transparent business owners. They tend to follow these exercises, whether or not accounting standards mandate, or whether they get tax benefit or not. It is about creating a legacy of trust for their shareholders and other stakeholders at large. So this is broadly the driving factors for your PPA exercise. Now, how does this work is, this is broadly what we are trying to value when we do PPA. We are not just valuing the intangible assets. We don't jump directly into valuing what are the intangible assets. Now let's start, identifying and recording it. How it starts, it's a process starting from purchase consideration. You start from valuation point of view. You first look at the purchase consideration that is paid. As a matter of fact, under Ind AS 103, it is mentioned that the entire purchase consideration and should be fair value. So, for example, even if a company A purchased, say, 20% stake in company B in 2001, and in 2021 it is purchasing the balance 80% stake, then they have to fair value even the 20% of consideration that was paid, say, 21 years ago, right? So the accounting standards mandate fair valuation of purchase consideration. Second point, while fair valuing purchase consideration that comes up is when we talk about generally, at least the startup acquisitions that are happening today in the market, we see a lot of complex clauses that are attached to purchase consideration, especially the ones relating to earn-out. So whatever is the purchase consideration, it is not paid out upfront, it is staggered, and usually, more often than not, it is pegged to certain milestones being completed or achieved. So only when the company reaches an EBITDA of certain percentage, that is when a certain percentage of the purchase consideration becomes due. That is how it is staggered. And being a valuer, you will have to then plan out and assume a lot of things and find out when this purchase consideration will actually be paid out. So if 50% is paid today and balance 50% is to be paid in the next 3 to 5 years based on milestones, you will have to sit with the management and understand the business plan of the management. As a valuer, you'll also have to assess whether what the management has said is completely practical, because more often than not, management tends to be more positive or more optimistic about their business plan. So as a valuer, you'll have to look at all the loopholes in the business plan, if any, and find out what is the realistic timeline when the 100% purchase consideration can be will be paid out, and what will be the fair value of that purchase consideration as on the date of acquisition. So the first step itself is a long process. Next, when we finally finalize the purchase consideration, what happens is we'll have to now allocate this purchase consideration to the assets and liabilities. As I mentioned, we cannot just copy paste the book value. We'll have to assess whether the book, whether the assets, even the tangible assets that are standing on the that are recorded and present on the balance sheet as on the acquisition date of the target, are those tangible assets valued at fair value? If not, you may have to fair value those assets. Classic example that we come across is the inventory. There are chances that there is dead stock in the inventory, which is being carried forward year on year basis at book value, but honestly that is not realizable. In that case, it should not be counted in your tangible asset valuation. Second is the debtors. Ideally you should check whether the debtors are also realizable or recoverable or not. If they are not recoverable, then it does not make sense considering them as an asset when there is no recoverability that is seen by the management, right? So identifying and valuing tangible assets, and similarly tangible liabilities or whatever is already recorded on the books, that also has to be fair value. There might be cases where the liability might have shot up, which is not accounted, but of course you'll have to take that into consideration when you're actually valuing your tangible and intangible assets and liabilities. Moving on to intangible assets, how do you usually start with valuation of intangible assets? Is there are two things. One thing is thoroughly reading the agreement that has been signed, starting from the term sheet or any other documents that might have been agreed upon by the target and acquirer, between the target and the acquirer, and till the date of actual execution and transfer. Because there are times that you will see change in terms. You will have to dig deep and understand why there were certain CGUs that were excluded, why were certain CGUs considered specifically, and that will help as a value, that will help you identify which are the how the negotiations have panned through the cycle. Also, it will help you identify other intangible assets that are already listed in the agreement. More often than not, you'll find that agreement lists a lot of intangibles. For example, non-compete is something that you will see mostly in every agreement. Second intangible that you can see is the customer contracts that will be carried forward and transferred to the acquirer, and so on and so forth. So it would be very easy for you to actually find out or identify what are the intangibles that have driven this entire transaction in the first place. Second thing that you will have to do as a valuer is you'll have to sit down with the management and understand what did they perceive in the target to really acquire it. What made the target so lucrative for them to go ahead with the transaction? What is it that they see will come out of this association or transaction, right? So management insights are very important. How they have seen the entire process, the entire transaction, and how it will add value, how it will bring synergies, how they will bring synergies, acquirer will bring synergies. All these things will give much more clarity to identifying intangible assets. And also, while having this discussion, it will become more and more easy for the valuer to choose the valuation approach and valuation methodology to value these intangibles. Moving ahead, now these are the broad level steps or phases that you would come across. Now identify, I think I've spoken mostly about all of these, but let's just touch base upon these. Identifying the business combination, of course, first and foremost is identifying whether the transaction falls under business combination or not. There are times when the business would be acquired under BTA, business transfer agreement, but it may not be a business combination really, or it may be a business combination for that matter. So actually checking whether it falls under the definition of business combination, because if it is not a business combination, the PPA exercise is not applicable itself. right? So if it is simply transfer of assets, then the PPA exercise might not be required at all. Second thing is recognizing and measuring the identifiable assets, liabilities, and NCI. So I have been speaking, whenever I've given examples so far, I've been speaking only about 100% acquisition, but of course there are times when you do not acquire 100% of the target. There are times when you have a majority stake. In that case, NCI will also have to be recorded. Also, one must keep in mind to read and record contingent liabilities that have become more or less foreseeable, right? So all the contingent liabilities that were not foreseen at the time of, or say, the last balance sheet that was shared by the target might become more clearer by the time a PPA exercise is being conducted. So in that case, it would be wiser to record these liabilities as well, because these did exist as on the acquisition date, although the auditor or the CA of the target was not aware of it. He might have classified it as a contingent liability, but if a liability existed as on the date of acquisition, that will have to be recognized by the acquirer. And recognizing and measuring goodwill or capital reserve. So ultimately, after measuring and identifying all the assets, including intangible assets and liabilities and NCI, whatever is the balance that remains, the excess of aggregate acquisition excess of purchase consideration as on the acquisition date will fall under goodwill or capital reserve, as the case may be. Moving ahead, what are the phases of PPA in a transaction? So whenever a deal is being evaluated, so even before a deal is actually executed, you will have to, at least in today's scenario, it has become very important for the parties to consider what would be the impact on their financials, because of course everyone is much more aware, all the investors are much more vigilant now, and you would want to understand what is the potential synergy before actually jumping into the transaction, right? So that is why a PPA process may be conducted, PPA may be initiated even before the transaction has begun. I'll just swiftly browse through these slides because I understand the time is less, but
Krupali, just to interrupt.
Yeah.
Would you like to complete your presentation and then take questions, or you can pause in between and take the questions from the chat box?
I would like to take it at the end, because I believe most of the questions will be answered as we move forward. But if you feel something is
no, it's up to you. It's not our choice. It's up to you. If you feel comfortable taking them at the end,
you are comfortable with that, and your questions are getting covered. No issues.
Right. Because this PPT is fairly elaborate. That's right. Right. So as I mentioned, in today's world, there has been a paradigm shift in which requires a PPA to be considered even before the deal is closed, to understand what would be the impact on P&L balance sheet of the acquirer, how it will pan out even in future, and how the market will perceive such an acquisition, what would be the reading of analysts on the transaction. So that is why it becomes very important to possibly consider a PPA even before the deal is closed. This will also help management to negotiate a better deal as things become more and more clearer, right? And of course, what would be the issues that would be this slide just covers what would be the issues if PPA is not considered at all, or not done. So of course there would be a negative impact on P&L, lower EPS, lower credibility, and losses in the value from management point of view. It will have adverse impact on the projections also that would be submitted for the valuation exercise itself, right? And there would be further impairment, further amortization, further negative impact. So this can just spiral into a different a negative aspect of the transaction itself if the PPA exercise is completely neglected. That is why PPA, although it's not something that you would come across very often, it is a very important part of the deal. Now an overview, as I mentioned earlier, this is how you can think about the entire process. First, we fair value the purchase consideration. We break it into the fair value of assets and intangibles, which we usually call goodwill. That is how academically we perceive goodwill. But this takes PPA takes this process one step ahead. The goodwill is also broken into identifiable intangibles and only the balance, which is absolutely not recognizable or attributable to any intangible asset at all, will be recognized as goodwill. And only this goodwill usually is tested for impairment, and intangibles continue on your book, on your balance sheet as it is on year-on-year basis. Moving ahead now, why is, of course, you will have to value the business also. This is a small part of the entire PPA exercise. The valuation of business becomes important because you want to know whether the purchase consideration exchanged is the fair value of the stake acquired or not. So that is why it is very important to understand what is the fair value of business or what is the enterprise value. And from enterprise value, you can derive equity value by reducing net debt. That will give you the equity value, and further, what is the value of the stake acquired. Broadly, it should be in line with the purchase consideration exchange. If it is not, then there is a matter of concern. Either the valuation of business was wrongly conducted or the purchase consideration is not fair. Is it a bargain purchase? In that case, you will have to assess. If it is a bargain purchase, you'll have to sit with the management and understand why at all the target agreed for a bargain purchase. So as you progress into the valuation exercise, you will learn how the deal actually was executed and what are the final aspects of the deal, which will further strengthen your hold on the assets that the company is bringing on the table, right? Now, how does the PPA progression happen? Now, if I move on to the first slide, of course, fair value of assets can be handled by the valuers very easily. Purchase consideration valuation also can be handled by the valuers very easily. What happens is that identifying intangibles is a challenge. What happens is there is specific criteria laid down in the accounting standard, which will help us identify the intangible assets. Now, first of all, whether it is an intangible asset or not, any asset that is recognized in the process, whether it is an intangible asset or not. If it is an intangible asset, then whether it classifies to be or whether it is eligible to be separately recognized in the balance sheet or not. Now, over here, identify intangible asset. Now, first of all, to identify an intangible asset, you will have to see whether it is non-monetary, it lacks physical substance. Of course, if it has a physical substance, there is some document to back the instrument or something, then it is not an intangible asset. So first of all, whether it is an intangible asset or not is, these are the three criteria that we will have to evaluate together. It has to meet all the three criteria to be an intangible asset in the first place. Second criteria is expected to generate future economic benefits. This is the basic definition of an asset. If it cannot generate future economic benefits, it is not assets. It is not an asset at all, right? And it has to be controlled by the entity at the date of acquisition. If it is not in the control of the entity, if the target does not have full control over the asset itself, then it is not an intangible asset that is coming with the transaction, right? Moving on, once the intangible asset is identified, whether that intangible asset qualifies for a separate recognition in the balance sheet of the acquirer or not, it has to match either of the two criteria mentioned here. One is contractual legal criteria if it is arising out of a contractual legal obligation. If there is a contract in place that recognizes that is enough for the intangible asset to be recognized separately on the balance sheet. Second thing is it can be separated, separability criteria, which is known as. How do we check separability? Is not just that you can separately identify the asset. You should be able to separately, monetize the asset, or maybe how we see it is whether you can sell the asset separately or not. If you can take out that asset, that intangible asset, and simply separately sell it out, if you feel as though there could be somebody who would be ready and who can possibly buy this asset separately, then the separability criteria is met and that asset can be classified and recognized in the balance sheet of the acquirer. If it does not meet both these criteria, it is either or. If it is a contractual obligation, okay, you can recognize. If it can be separated from the other assets and the entire setup that the target is giving away, then you can recognize. But if it does not meet any of these criteria, then that asset cannot be separately recognized as an intangible asset. Although it has been identified as an intangible asset, it cannot be recorded as per the accounting standard into the balance sheet of the acquirer. Moving ahead now, how do we actually value these intangibles? What are the approaches and methods? Now it is very much similar to how we value businesses. There are three broad approaches even in case of intangible valuations. Excuse me. First is market approach. Although this is the most favorite approach, this is the most preferred approach. One of the major setbacks over here that we face as valuers is that we do not find enough similar or same transactions, similar assets that are transferred on similar lines like the transaction that we are involved in. So it is very important to have or identify the right transactions or right comparables for market approach to be applicable. And because this cannot be done very easily, because more often than not such similar transactions around the date of your transaction might not be available with similar terms and conditions in the transaction that we are involved in may not be available. That is why the actual usage of this approach becomes very low. Second is the income approach. This is the second preferred approach because this captures all the future economic cash flows that will be generated from the asset, right? So as we see even in business valuation, the second preferred approach is the income approach, and third approach and the least favored approach is the cost approach. Although this is least favored, but this is more commonly used for valuing intangibles, whereas we do not see the asset-based approach used very often in case of business. But cost approach is not completely dismissed when we are valuing intangibles, because a lot of intangibles can be valued based on replacement cost or reproduction cost, as you will see when we move ahead with this slide. I'm not diving into the specific methods over here because these are a little complex methods. We will see them in detail as we move forward. Now, before we jump into what are the approaches and what are the actual methodologies, these are certain terms that we should be aware of. What is the fair market value? What is the fair value? And value in use. This is very commonly used by all the valuers and very common in the valuation community. That is why I'm not divulging on this slide as such. Valuation approach, of course, as we mentioned, market approach is the most favored approach, but the issue with this is that identifying similar transactions becomes very difficult, and getting the required data on those similar transactions is another challenge altogether. All this data is usually not even available in public domain, so as we struggle for comparable companies and comparable transactions, this is the level of difficulty getting this kind of data is much higher when we talk about identifying intangible assets, because so much detail of the intangible assets being identified by the acquirers. Usually acquirers do not disclose even the purchase consideration, or because as you must have seen, identifying and getting comparable transactions data also becomes very difficult. So getting further details of what were the intangibles identified and how those were valued is another challenge altogether. So this is fairly this is the approach which is least used because of the lack of relevant data that is available. Most commonly used approach that you would see is again the income approach. As we know, this is because the income approach takes care of all the future cash flows that would be generated from the asset. That gives a better valuation to the asset, right? So that is how this is done. Now, if you would have seen the previous slide, there were four different approaches or four different methods that were mentioned under that slide. Here, I will just broadly touch upon these methodologies. First and foremost is the multi-period excess earning method, which is called MEME, popularly called MEME in the PPA exercise. Here, what we do is we calculate the net income generated by the intangible asset or the CGU, and we subtract the charge from CAC is contributory asset charge. We reduce the charge from all the assets except for the asset that is being valued. So the net cash flows that remain would pertain to the subject intangible that is being valued, and these cash flows are then present valued with the appropriate rate of return to get the value of your subject intangible asset. To this present value, we add something called tab, which we will discuss shortly going forward. So the final value that comes from the present value of the future cash flows and the tax benefit that tax amortization benefit that will arise from the subject intangible, the gross value is the actual value of that subject intangible asset that we are valuing. Second method is relief from royalty method. This is commonly used for say brand, or when the brand is not when the brand is not the most important asset of the transaction. You can use relief from royalty method, wherein we assume certain percentage of royalty that would be paid to the brand owner or to the license owner for using the license or for using the brand, and we deduct the relevant costs from it, and that is how we get the cash flows generated from relief from royalty method. This cash flow which is identified, or this cash flow which is calculated, which was actually a relief for the acquirer. They did not have to pay royalty to the brand owner because now they get the brand, right, through the acquisition. This cash flow is present valued. Again, tab is added for any tax benefit that would be generated, and the gross value of these cash flows stands as the value of your intangible. Third method is incremental cash flow method, or with or without method, as we popularly call it. This is usually used for intangibles such as non-compete. So what would be the cash flows that would be generated if the non-compete was not in place. So you draw up cash flows, or you draw up a DCF model that we expect, that the management expects with the non-compete in place. Second cash flow or second model would be assuming that the non-compete is not in place, and the differential or the incremental cash flows are calculated. There is a probability of of the competition actually taking place that is considered, and tab, of course, if any tax benefits are expected out of it, that would be considered. And the gross value that comes in is the value of the asset that we are trying to identify and value. Last but not the least is the direct cash flow method, or the greenfield method, also called the build-up method. Here we assume that the company had or the entity has no asset except for the one asset that we are valuing. Right now, in this case, you build up the cash flows on this assumption, the basic underlying assumption being that the only asset available to the company or present with the company is the subject intangible that we are valuing, and all the other assets that are required are built up into the DCF, and the cash flows that are generated, of course, they are attributable to the one intangible with which the company began, or with which the entity began its operations. This is a hypothetical assumption, but there's only one DCF which would be drawn up in this case, and present valuation of these cash flows will help you calculate or determine the value of that subject intangible asset. Moving forward, now, what are the valuation approaches? Third one, cost approach. Cost approach is also used by the valuers to value certain intangibles. In case of cost approach, the basic underlying assumption is that any prudent investor would not pay anything more than the amount that they would pay to actually purchase this intangible from outside. So if I am getting getting an intangible in a transaction, I would not, if I were not to take that or acquire that asset from the target, how would I get it otherwise? I might acquire it from outside, from a third party or from the market, and I would pay a price for it, or I would produce it myself. I would construct it myself internally, and I would see what is the cost that I would incur to replicate the intangible that the target is giving me. Logically, I will not pay even 1 penny more than the cost that would be incurred to actually acquire this intangible from outside, right? So that is the value that can be attributed to that intangible. Usually this is done for the intangibles that are not the driving force of your transaction. So although this is most commonly used for valuing intangibles such as websites, software, but in case of startups or in case of companies where they are trying to sell their software, the software itself is driving the transaction. The acquirer is acquiring the target for the robust software that they have created, right? Or the different features that they have come up with. So in that case, the software might not be valued based on replacement cost or even reproduction cost, because the acquirer, even after paying a lot of money, may not have the expertise to replicate the same kind of software with so much robustness. So in that case, you may not want to go with cost approach for something that is actually driving your transaction. So a thumb rule or a very important rule when we are evaluating what methodology to be used when we are valuing intangibles is that we should not use cost approach for the most important assets that are acquired in a transaction. And another point which I missed to mention earlier is, usually if you see whenever a PPA exercise is conducted, you would see MEAM method, multi-period excess earning method, is used for valuing the asset, which is the core asset or the most important asset in any transaction. Because you would want to say that all the earnings or all the income that is generated by the entity or by the CGO is actually driven by the most important asset. For example, brand. If brand is the driving force for your CGO, mostly in case of FMCG companies, you will see that brand is actually the most important asset that they are acquiring, that is the driving force of the transaction. So in that case, you will use MEAM for valuing brand, right? Because whatever is generated, it is actually being attracted, all the customers are coming back, all the growth that is coming into the company, the margin that is increasing or improving is happening because of brand and the strong brand that is being created year on year basis. So in that case, you will use multi-period excess earning method or MEAM for valuing brand. So one of the important takeaways or key takeaways you can say is that if the most important asset intangible is identified, you may want to use MEAM for valuing that asset. And you may not want to use cost approach for valuing the asset, which is actually at the heart of the transaction. Although it is very common to use cost approach for that intangible, like I mentioned, software. Similarly, when I mentioned brand, you would see usually brand is valued using relief from royalty method. But when I was personally involved in a major valuation exercise for an FMCG space, with a lot of discussions with the management and even the ground level team, we understood that actually the heart of the transaction, or what is driving acquirer to buy this entity, which was actually loss making entity, is the brand that it has created. Although it is loss making, the brand value that it has created in market for itself is unmatchable. And that is why we moved from using relief from royalty method to MEAM for the brand. So this is how you will learn through the process of discussion with the management, reading through the agreements, and even discussing at ground level who are actually running the deal or helping with the transition, right? Sometimes the management may also introduce you to the management of target because they would be better placed to make you understand how certain intangibles are developed by them. So that is how you will have to think a lot, discuss a lot, and evolve out of the PPA exercise and identify which is the most relevant method for the identified intangibles that you have come up with. Now, talking about the methods, income approach methods. Let's talk about relief. I'm not really reading through all the slides because of the time that the shortage of time that we are into. But broadly speaking, the income approach methods are all based on one underlying principle, which is of the capitalization of the future cash flows, which is discounted usually using the relevant discount rate, or sometimes using the capitalization factor. Moving ahead, first method that I would like to speak upon is the relief from royalty method. As I already mentioned, how this works is it involves actually forecasting the relevant financial parameters. Mostly it would be, say, turnover. So the premise is to assume what is the royalty that you would have paid had you not acquired this brand through this acquisition, right? That is the underlying principle for relief from royalty method. In this case, most important inputs for actually running the model would be the royalty rate, because it is very important to have the right royalty rate. When we talk about royalty rate, we also have to understand what is the corresponding financial parameter. Usually, as I mentioned, it would be turnover, but you will also have to see what are the comparable. Usually, you'll get the royalty rate from the comparable royalty rates that are available in the market. Now, you will have to see what were those, what were the terms and conditions for the other royalty rates that you are considering for determining the royalty rate for your brand, right? Because it can be so that the royalty rates that you are considering may have come with different terms. For example, there may be a lump sum payment and royalty on year basis, whereas your model has not or has forgotten to assume a lump sum in at the beginning. So it becomes very important to also look at the financial parameter and the terms for your comparable royalty rates and to determine the correct absolutely relevant royalty rate, because this is the crux of the methodology, as you know. Second thing is the projections. Now, of course, if the royalty rate is to be applied on a particular financial parameter, that financial parameter should be appropriate, or the estimate of that financial parameter cannot go haywire. This you will usually you'll find from the projections that are shared by the management, which you would have already used for the valuation of business, as we saw initially, right? So the projections would definitely would have been shared with you by the management. But as I mentioned, that we'll have to dig deep into those projections. We should not get carried away by the extreme optimism or pessimism that might envelop around the transaction, and look at it from a neutral point of view, whether the financial parameter estimates are sustainable and logical or not. Third is cost of marketing or any other cost that would be borne by the licensee in utilizing the asset. So although I am not paying royalty, right, for utilizing the brand, I might have to incur certain SG&A or selling and general admin expenses, or some promotion expenses, or some advertisement expenses to maintain the brand, which would have been incurred by the brand owner. So here our assumption is if we were not owning the brand, what would be the royalty that I wouldn't have paid. But I should also think about it from this point of view, that I will also have to incur certain marketing costs if I am owning the asset. That marketing cost will also have to be netted off from this relief, because this is something that I am going to bear going forward, because I have acquired the asset and I will have to maintain the asset. And last but not the least, the tax relief that will come with recognition of this asset. If the asset is a recognizable asset under tax laws also, and if the tax laws of your country allow you to amortize this asset on year basis, the tax benefit that will arise out of this will also be added to the value of asset, and all this in whole will sum up to the value of the intangible that we are valuing. And of course the discount rate. So whenever we are talking about projections and the royalty that would be incurred or that will not be incurred, and the cost going forward, all these will have to be present valued at all times with the relevant discount rate. Second thing that is there are certain qualitative inputs also that you will have to bear in mind when you are looking at relief from royalty approach. So as I already spoke, there would be advertising costs, there would be barriers to entry. Even though you will assume certain royalty rate or certain license fees, suppose you're valuing a license as an intangible, you might say that this is the license fees that someone is paying for utilizing the license, and go ahead with your model. But you should also see what are the barriers to entry. Getting the license itself may not allow you to participate in the industry or in the market, whereas the target might have established itself as a market participant, as an active industry participant, which will help you continue the legacy and earn out of the transaction or the license or the rights that the target is sharing. right? So these are some of the qualitative inputs that you will have to consider before actually going ahead and finalizing the value of intangible asset that we are valuing. Second method is profit premium method. Here, as I mentioned, this is also called with and without method. It is based on very simple premise of assuming that we have the asset and assuming that we do not have the asset, and what would be the differential cash flows that would be generated, that we are able to generate by actually owning the asset. Ideally, and it would be the case always that the forecast period profit or cost savings or cash flows that are expected to be generated by not owning the asset will be lower than the cash flows that are generated by owning the asset. In that case only there will be any value to the asset, otherwise it's not an asset at all. So the incremental cash flows that we are able to generate by actually having or owning that asset is the value that is attributable to the asset. Of course, the cash flows will be discounted at the appropriate discount rate again, but that is broadly how you can attribute or how you can think of the profit premium method, or with or without method as it is popularly known. Third method is the excess earning method. This is very common and broadly or widely used in every PPA exercise. You can assume that MEAM is the right method for valuing most important or the intangible asset that has actually driven the transaction. So more often than not, you will be able to use MEAM for valuing the asset which is at the heart of the transaction. Over here, when we talk about MEAM, we'll have to understand certain other concepts like contributory asset charge. Now, the relevant inputs for MEAM are contributory asset charge to begin with. This is the asset charge of all the assets that is acquired or that is actually running the business or the CGU, apart from the asset that is being valued. So this would include all the assets, all the tangible assets, as well as other intangible assets. For example, if I'm valuing brand using MEAM, there might be other intangible assets also, like say software or assembled workforce that would be acquired in the transaction. Now, when I am deducting the contributory asset charge, I will reduce CAC or CAC for fixed assets, net working capital, etc., and also for all these other intangibles that are identified. So you would have already guessed by now that MEAM is something that you can, MEAM model is something that you can run at the end of your PP exercise, or when you're actually done identifying all the other intangibles, and the last step or the last intangible to be valued or last method to be run has to be the MEAM method. Of course, in very complex situation where there are say two or more assets that are at the crux or at the heart of the transaction, you might run MEAM for two such intangible assets. In that case, what will happen is there would be a cross reference or a circular reference for the charges that would be created. It's a very complicated model that that you might end up with, but most common thing that you would see is that there is only one main asset which is being calculated or valued using MEAM method. So CAC is something that you would require for every asset, including other intangible assets. Second thing that you would require is the relevant forecast cash flows or the projections that we spoke of even in previous slides. So for all the methods under income approach, you will have to ensure that the forecast cash flows are logical, relevant, sustainable, justifiable, and as a valuer, you should be convinced that the cash flows are something that can be attained by the management going forward. And last but not the least, input is the discount rate. All these cash flows, once deducted or reduced by the CAC of all the other assets, will have to be present valued based on the most appropriate discount rate. This is how you would end up with the value of all the cash flows. You will add to it the tax benefit, if at all available in your country. And that is how you will summarize and sum up all the cash flows that will be generated from that asset and reach the value of the intangible asset that you are trying to value. Now, how do you determine CAC? It generally comprises of 3 steps: identifying assets, contributing to the cash flows. As I mentioned, when you are doing MAME, you would have already completed identifying all other intangible assets. So obviously you would know what are the assets that are contributing to the cash flows. These assets include other intangible assets also, as I'm repeating myself. Measurement of the fair value of such assets. Now these assets should also have been fair valued already. So you should have completed the entire valuation exercise up to the phase of actually running the MAME. So if you have identified, say, workforce, if you've identified software non-compete or any other intangible at all, ideally the process of actually valuing all the other assets would have been completed by the time you're trying to run a MAME model and derive CAC. And third is determining an appropriate fair return on the capital value of such assets. So what would be the fair return on such assets? Just to give you an example of how you can determine on the fair return on capital assets, on the capital value of asset is, for example, when you are talking about, say, fixed asset, if I can get a machinery or the PPA that I have identified, I can fund that through, say, debt to the tune of, say, 80% debt and 20% equity. My fair return on capital would be 80% weightage to the cost of debt and 20% weightage to the cost of equity. Right, and the weighted average return that I would calculate is the fair return on the fixed asset that I have acquired. If I can generate, if I can fund, say, working capital to the tune of 70% by debt, and there is a certain cost of debt for that kind of working capital, I would give the weightage of 70-30 to debt and equity, and that is how I will generate the or calculate the fair return on such capital value of that asset. Now, when we talk about intangible assets, or when we move to intangible assets, what happens is usually you will not find any financial institution backing you on such intangible assets. When there is when the assets are intangible, of course, there is no security to these financial institutes, whether it be banks or NBFCs or any other financial institutes. They will usually not fund your intangibles. In that case, your return on the intangibles will be higher than the return that you are expecting on to be generated on the fixed assets and working capital or any other tangible assets that you would have identified. Assets for which now moving ahead with the CACs. Now when you have actually completed the calculation of CACs, you will also run at the end, because by the time you reach the phase of actually running MAME, that would be the last intangible that you're valuing. So you would have your IRR in place, because you would have run the business valuation in the first, as we discussed in the initial slides, right? In the first phase itself, you would value the business and you will see what is the IRR or the internal rate of return for this transaction given the business plan that is shared. Second thing is the WACC. WACC also you would have already calculated when running the business valuation, and VARA you would have calculated when you are calculating CAC. So before you conclude any valuation exercise, any PPA valuation exercise, you must check for the alignment of WACC, VARA, and IRR. Ideally, these three should be more or less aligned, or should approximate to each other rather than being too diverse. If these are not aligned, then that is a matter of concern, and you might want to know what has deviated so much. So this is just a validation check that as a valuer you will always run. And although this is not directly part of your PPA, or it may not be directly part of your PPA deliverable, this is something that even the auditors might ask you, and this is something that you can keep in your working papers for the safety of yourself, or for the logic explanation, or to explain how you have concluded that the WAC and VARA that you've calculated is correct, because it is aligned with IRR, right? The last method under income approach is build out or the greenfield method. As I mentioned earlier, this method assumes that there is a hypothetical startup or a hypothetical entity which has no assets except for the one asset that we are valuing. Usually this is used for valuing assets like license. So for example, if you were given only this license and told to set up your entire business, what would be the expected capex or working capital requirement, and what would be the inflows that would be generated through the sales and through the EBITDA that is generated. So this is the basic premise of a greenfield approach or the greenfield method. And whatever are the cash flows generated with this assumption are the cash flows attributable to these are the cash flows attributable to the intangible asset in discussion, right? So you present value all the cash flows that are generated with this model. This is a single DCF that you will run, and the value derived is the value attributable to the license or any other intangible that you're valuing using this approach. Some of the key assumptions here are that the entity that is hypothetically assumed to be created, or the startup that is expected to set up the entire business by itself, that is why the name greenfield, that is backed by a very strong or very large parent company which has no restriction on capital. So there will not be any restrictions on capital that you will face when you're actually setting up the business. Whatever capex is required, whatever working capital requirements are required, will all be met under this assumption. Second thing is the limited learning curve. Now the management team of the startup company, which we are hypothetically assuming will be set up, is already well equipped and has sufficient knowledge and expertise to quickly and effectively develop the company and run it and start monetizing it. But if you see any startup, you will know that this is not usually the case. It is a learning process for the management also. But in this case, when we are talking about the greenfield method, these are the two basic underlying assumption that we are moving ahead with, that there is no dearth of capital for the company, and the management is well equipped to sort of run the company from the first day itself. Now, moving on to the important terms before we actually jump on certain examples is the remaining useful life. Now, you will first check whether the intangible asset identified has a finite life or infinite life. Now, if the intangible asset, which is meeting the criteria of eligibility, has a finite life, you can record it on balance sheet and amortize this based on the balance useful life. However, you must remember that although you get tax benefit over here in most of the countries, this has a dilutive effect on the EPS that you will generate on year-on-year basis. So although there is no cash outflow from the company, but this will reduce the EPS for your company or for the acquirer because of the amortization that is hitting P&L on year-on-year basis. If the remaining useful life is infinite, it cannot be determined as on the date of acquisition at least, then it can be recorded on the balance sheet. but it cannot be amortized, and hence it will not have any impact on EPS. But this will be tested for impairment on year-on-year basis. It will have impact on financial statement only and only when it is actually impaired. So when your intangible asset is actually impaired, that is when you will have to write it off, and that is when it will hit your PNL and hence the EPS going forward. But that is the situation when the value has eroded from the target, and that is the worst case scenario for any acquisition to end up with, right? So when you start the acquisition or when you are actually valuing this, you are in the process of the transaction. That is the time when you will not think about impairment. And this is also why the goodwill at the valuation of goodwill becomes very important. If the goodwill cannot withstand the test of impairment on year-on-year basis, then the impairment loss that will hit the financials of the acquirer will be highlighted, and again the fingers will be pointed at the valuer for probably missing out on correct or appropriate valuation of goodwill. So I'm talking about goodwill because goodwill is one asset which has infinite life and which is usually a part of all the valuation exercises of all the transaction. Another intangible with infinite life could be brand, wherein the management say that the brand has no end to itself when you are doing name, and if you are assuming a terminal period approach when you're valuing brand, this is an underlying assumption even for such a valuation that we are running. So these are the two assets that usually fall under the category of infinite life, and which will be usually tested for impairment on year-on-year basis. Another very important topic to understand from PPA point of view is the tax amortization benefit. Now, TAB or tax amortization benefit is the hypothetical tax benefit that is associated with amortizing asset on year-on-year basis under the income tax provision of your company, of your country. Now, before actually calculating and attributing TAB, it is very important to establish whether or not TAB is available, tax benefits are available or not in the country of acquirer. If the acquirer is not going to get the tax amortization benefit, then in that case, it does not make sense to actually attach any value to TAB, because those tax benefits will not be realized at all. Second thing is, if at all the tax benefits are available, what are the terms and conditions, if whether the intangible that is being acquired will meet the terms and conditions under the income tax provisions of such country. So this should be very clear whether the tax benefit is actually available or not. If it is available, then the calculation of the benefit out of it will arise. So the question is, what is the tax benefit we are talking about? Tax benefit is the amortization expense that will be allowed as a taxable deduction, that will be allowed as a deduction while calculating your taxable income. So like every deduction that you get for every expense incurred by the business, income tax laws do allow, at least in India, to take the benefit of amortization of these intangible assets, just in line with how they allow depreciation to be an allowable expense under the tax laws. So if this amortization is allowed, you will attach certain value to it. You will run the depreciation model or the amortization model and see how the tax benefit will actually pan out for the company, and how it will be capitalized and utilized by the acquirer. This will add to the value of the specific intangible which is allowed the amortization in tax laws. So this is the tab that we speak about when we talk about tax benefits under a PPA exercise. Required rates of return. Now you must have seen me talk about these three rates of returns, majorly WACC, VARA and IRR. As I mentioned earlier also, your WACC, VARA and IRR must align. If these are not aligning, then definitely there is an issue with either the valuation or there is something more to the transaction that you are not aware of, and you might want to discuss with the management. So there can be a time where the IRR is much higher than the WACC and VARA. So that may be because it is a bargain purchase, and actually there have been practical instances where IRR was not aligned with WACC and VARA. But even in that case, as a valuer, to go ahead and issue a report stating with WACC, VARA and IRR not aligned, you must have a logical justification for such a deviation, if any. But more often than not, you will see in 99% of the cases, your WACC, VARA and IRR will automatically align. Will automatically align if all the processes are conducted diligently, if all the discussions have been factored into, all the calculations are run appropriately. These three will align by themselves by default. Now certain components that are required for actually getting these rates of returns. One is the WACC. WACC is comprised of your after-tax cost of equity, after-tax cost of debt, and what will be the sustainable capital structure or target debt to equity ratio for any market participant. Second is the VARA. VARA is the after-tax rate, will comprise of after-tax rate of return, after-tax return by the asset class, and actually identifying different asset classes. So as I mentioned, you will have to identify different asset classes, including intangible assets, while actually valuing or deriving CAC. In this case, CAC will also, go hand in hand with the calculation of VARA. So VARA, while calculating VARA, you will have to, basically have the after-tax rate of return for each asset class. Now, even when we talk about, say, intangible asset, there would be different intangible asset class assets that would be created or acquired with different after-tax rate. So in that case, you will have different classifications, and the weighted average rate is the VARA that we are talking about. And last but not the least is the IRR. Therefore, running the IRR, for actually calculating the IRR, you will need the business plan that would be shared by the management, vetted by you. You should be convinced with the projections and the purchase consideration that you would have already derived. So the implied rate of a return from the project or from the business is your internal rate of return, or IRR. As mentioned here, again, IRR should not be very different from WACC or VARA. Few basis point up and down is okay, but difference of 1 or 2 basis point, 1 or 2 percentage, or 100, 200 basis point, 300 basis point is alarming and might actually be a flag off for you to dig deep and do some more research. Now, I have shared some sample workings over here for certain calculations that I've done on for different intangible asset valuations. This will help you understand how the model actually looks like and how the numbers pan out to be. I've started with the most easiest one to the most complex one, being mean. This is an example of valuation of database based on replacement cost. Now, database is something that you can buy easily from the market. So if there is a customer here, we were trying to value customer database that an FMCG company had gathered over 5 to 10 years of operations, which was being acquired. Now, although the management of Target felt that this was something very valuable, when we spoke to a lot of people in the market, in the industry, we got to know that active users database is something that is easily available in the market. right? So if I can get active user database from the market from a third party, I will not consider it to be a very important intangible in my transaction, and that is why cost approach was used to value this intangible being database. Cost of acquisition of database per active user is 325 rupees over here. uh, so 325 rupees is coming. So I'll just tell you how we also derive the inputs, because as valuers you would want to know how we are actually getting these inputs also. So cost of acquisition of database per active user is something that you can get quotations from the market. This is the active quotation that we got from the market for the field that the FMCG was into, which is health and wellness space. So health and wellness active user database, if I were to acquire, this is the price that I have to pay. And what was the database shared by the target? So target came with active user database of 2.25 lakh users. So accordingly, I have calculated the value of acquiring such a database from outside, and that is the value that is attributable to this database. Moving forward, second is assembled workforce method. This is also a replacement cost method. Why I have put this is because assembled workforce is a part of almost every PPA exercise, right? And it is almost always calculated based on replacement cost only. Major cost being the recruiting cost and the productivity cost that would be avoided. So these are the costs that an acquirer is avoiding by actually acquiring the assembled workforce which is already trained. So if I were not to get this assembled workforce as it is developed by the target, what I would do is I would actually go out and recruit these many employees at whatever cost annual salary that is shared, and I would have to also spend something on training these executives or these employees. So that is the cost I have avoided, the training cost, not the salary. Salary you will anyway pay after acquiring the workforce, right? So the costs that are avoided by an acquirer are the training cost. Second is the recruiting cost that you would pay to the HR agencies, and third is the productivity cost, because every time you recruit an employee, he will not start with 100% productivity. He might be productive only 50% of the time, and it would take a month or two for him to actually have 100% efficiency into your system. So this is the cost that you are avoiding by actually acquiring a fully trained workforce at the first day of your business itself or on the date of acquisition. Third thing is relief from royalty method, which is, as I mentioned, usually used for valuing brand. This is how you would see the revenue based model. So the royalty was being paid on the revenues that are being generated from the brand. So you would have revenues attributable to the brand. Mind you, if you have 2 or 3 or more brands that are being acquired, you will have to be careful that the revenue base for royalty is the royalty base for the brand that is being valued. So although the company might be generating say 1000 crores, but only 584 crores out of that is attributable to the brand that I am valuing as of today. So in that case, I will consider only the revenue that is attributable to the brand. I will assume a royalty rate, which is something that is available in the observable market. You will have to go through a couple of databases. Of course, as a valuer, you will have access to a lot of databases like royalty stat, etc., marketables, etc. So that will help you identify the right royalty rate in the industry that your company is, in the size of brand that or the size of market market approach, market value that the company already commands. So based on that, you will understand what is the relevant royalty rate. In this case, it is 5% that was identified based on compilation of about 10 to 15 royalty agreements that royalty agreement data that we found, and accordingly I have calculated what is the pre-tax income for owning this brand if I were to actually outsource this brand, so to say, to put it differently. So this is the royalty that would be earned out of these out of this brand, and what would be the income tax applicable on this. So that leaves me with the after tax cash flows on year basis. On that, I have also assumed terminal value, because we have assumed that the brand will continue forever. It is not something which has finite life, but you will come across models which have finite life. You may go up to 20 years, 30 years, but beyond 30 years, if the management cannot foresee how the brand will pan out, you may have to restrict your model to 20 years and not a terminal period assumption. So this is based on the particular exercise that I was conducting. On that, of course, you'll have to assume the discount rate. You will have to discount it, and you will be reaching the sum of present value of future cash flows. On that, you will calculate tab, and the total value of brand is the summation of the PV of future cash flows as well as tab. Now over here, another important aspect is how the tab of 84.7 is calculated. Let me show you the calculation of tab also, just for your better understanding. So here, when we calculate tab, this is how we usually assume. We assume that, suppose the asset is of 100 rupees. Amortization allowed under the income tax is on WDV basis, and at least in Indian taxation laws. So 25% amortization you'll see on year basis, and the closing balance which is carried forward in the next year. And what is the tax benefit? Tax benefit is 25 or 18.8 or 14.1, which is the amortization cost which is allowed into the tax rate applicable to the company, because entire 25 or 18.8 is not your benefit, that is the allowable expense. You must remember that the actual benefit will be of 4.72 or 3.54 in year 2, year 3. So applying a tax rate on the amortization is an important step, which when you begin, you might forget to include this also as a step. But you must remember that the tax benefit is not amortization, but the tax percentage on the amortization that is applicable to you. And summation of these, present value of these, is the tax benefit that you are availing on opening of 100 rupees. So if my asset was of 100 rupees, my tax benefit is of 2 rupees. Accordingly, what would be the tax benefit if my value of future assets or net amount is 356.5? So it is just cross calculation or simple mathematics that you would do, and you will get the calculation of tab. But there are finer points like the net value and gross value. So you should equate 100 to 441.2 and not to 75 or not to the net of 100 minus 19.2, if you know what I'm saying. So 100 minus 19, 80.8 is equivalent to 356.5 over here, if you are following the numbers that I'm talking about. So with that, if 80.8 of net asset value is yielding a benefit of 19.2, then what would be the benefit arising from asset value with net asset value of 356.5? That is how you will do the cross calculation and reach value of 84.7. You'll gross it up to get 441.2 of the total value of brand. This is a very crucial, exercise or very crucial calculation. That is why I'm spending some more time on it. Another method is a non-compete or incremental cash flow method. This is very easy. You can see the projected revenues assuming non-compete and assuming there is no non-compete. You will see there is impact on margins also, because if the competition will increase and such an influential competition, then you will have to take a beating on your EBIT margins also. That is the premise over here. That is why you will see your revenue as well as your EBIT margin being affected. The rest of the things will flow in line with the first cash flow itself, which is assuming the non-compete covenant. In this case, we will see that the debt-free cash flows generated under situation A and B are highlighted as A and B, and the differential is captured over here. And the PV factor of 20.4, assuming a discount factor of 20.4 is a discount rate of 20.4 is applied. Over here, I'm really sorry. I think the third year is not captured. There was some issue while pasting the columns, I believe. But broadly, you'll end up with, if you run the same differential cash flows, you will end up with a PV of non-compete cash flows of 41.3. Here you must remember that you are also going to look at the probability of competition. It's not that if the non-compete covenant was not signed, the promoters of the target were waiting to start a competitive business. It was not like that. So we will assume that even if the non-compete was not signed, there was just 50% probability that they would compete. In that case, you will also have to apply a probability of competition. It can also be 100, no doubt, but more often than not, this will not be 100. It may be something less than 100, because we cannot be 100% sure at all points of time. So do not forget to apply this probability when you are running this model, and you will reach the value of non-compete covenant before applying tab. Again, you will add tab on the same lines as we saw earlier. I'm not getting into the calculation of tab once again, but on the same premise, you will get a tab of 3.9, and the total value of non-compete covenant comes to 24.6. Last is the MAME model, which you can see is fairly complicated here. You will record the revenues that are generated through the brand that is being valued, or any intangible for that matter that is being valued. Revenues attributable to the intangible and adjusted EBIT margins for the intangible that is being valued is calculated. Of course, income tax is calculated based on the accumulated tax losses, etc., that is being enjoyed. And on this, after calculating the net income or the net loss of the company or of the CGU, you will also deduct further the contributory asset charge from these incomes. So you will see generally these are the standard assets that you will see: fixed assets, working capital, non-compete, and assembled workforce. You might also have database software, customer contracts, etc., which will be applicable in your case based on the intangibles identified. And you will deduct a cap or contributory asset charge from the income, and the net cash flows that are left is the cash flow generated purely by brand. How to read this is something I would like to share rather than going into actual mathematical calculation. How to read this is that out of all the income that is generated, I would say the CAC deductions that I'm doing is generated by that asset. For example, in year one, I will say 0.6 crore is generated by the fixed assets, or 0.6 of income is attributable to having these fixed assets, or say 6.1 crores is generated or is attributable to the database that I hold in place as on the date of acquisition. So this is how you can read. So these are the contributions made by these assets for generating income, and these are the incomes that are generated, or the contributory charges that are generated in a way by these assets, and whatever remains is the income generated by the asset that you are valuing, in this case brand. And this can be present valued again based on the relevant discount rate, and that is how you'll end up with the sum of present value of after tax cash flows as well as tab, and you will get the value of brand or whatever intangible that you're valuing. I have just given sample calculation of CAC for some of the assets. Now here you will generally see, just talking about fixed assets. Now here I have a weighted average return on FA of 9.8%. So what I'll do is, of the revenue, I will say what is the percentage generated by fixed assets, and what is the rate of return on that fixed assets. So 2.2 into 0.2 is what is generated, or is the CAC for FY21 by FA. Now this has to be averaged out for the life of the asset. So for FA, if I've assumed life of 3 years, then it has to be averaged out based on 3 years. Now in this case it is 0.20, it might be 0.1 something and so on. And also because this is approximated at the very last moment, this may not read correct, but because of rounding off, but it is actually an average of year 1, year 2 and year 3. That is how you will average out the CAC, and you will reach the final CAC which is applicable. So if you see here, the FA charge that I'm assuming is 0.1% of the revenue is generated by, or is the charge by the fixed asset. This is how you can read it, and this is how it will be done for all the assets. I've not captured all the assets because this is just the sample that I'm presenting for better understanding. So we have covered all the
how much
working.
extra time you will need? Some extra time now?
Yeah, no, actually this is just the last slide, and it is not very important. So last is the queries and a thank you slide. So should I take up queries?
So my colleague Snehal will help you take up the queries, the questions.
Thank you, Krunali ma'am, for such a simplified session on such a complex topic and wonderful examples as well. We have few questions. I'll ask you. These are in chat box also. But Tirumalaiji has asked, in what way M&A valuation is different from a valuation for public issue?
No, can you please repeat? In what way is?
In what way M&A, mergers and acquisition valuation is different from a valuation for public issue?
So M&A valuation, the premise for M&A valuation is usually the relative value that you are trying to derive. The major M&As that you would come across, especially from listed company point of view, is that the purchase consideration would be exchanged in shares, and you would want to see the relative value of the target company for determining this fair swap ratio, because it is very important that the ratio that is determined, the swap ratio, is fair. But it is not important for you to determine fair value of a target or fair value of the acquirer, right? So of course you thrive to calculate fair value, but the premise from pure academics point of view, pure theory point of view, is that you are looking at a relative valuation, whereas from public issue point of view, you are looking at a fair valuation to give fair costing or fair to determine the fair price of listing a company and giving it to the public. So the premise itself is different when you are doing M&A valuation versus a public issue valuation.
Thank you. Hemant sir has asked, ABC Private Limited will demerge and transfer her undertaking to ABC Limited. It's a listed company. Value of ABC Limited as per DCF and market comparable is lower than floor price as per SEBI. How to determine the fair value of ABC for recommending fair equity share exchange ratio.
No,
Should
can
I
you please, can you please repeat? ABC is an
ABC
unlisted.
Private Limited will demerge and transfer her undertaking to ABC Limited, that is listed company. Value of ABC Limited as per DCF and market comparable. Value of ABC Limited as per DCF method and market comparable is lower than floor price. Value as per DCF and market comparable is lower than floor price as per SEBI rules, ICDR rules. How to determine fair value of ABC for recommending fair equity share exchange ratio?
Okay, so here the thing is, you are saying that the listed entities floor price that is determined as per LODR or under the ICDR rules is higher than the DCF value or the market comparable value, right? So what happens is so couple of questions you will have to ask, or you will have to see. One thing is the public listed company ABC Limited, whether it is a frequently traded company or not. Now SEBI clearly specifies that the 2-week 26-week VWAP formula that SEBI has prescribed is applicable only to frequently traded companies, right? So if the company is not frequently traded, then the SEBI formula itself will not apply. That is one. Second thing is, if it is a frequently traded share, if if there is enough free float in the market to justify that the market or the value in the market in the exchange is the fair value, then you will have to relook at the DCF or the comparables. The comparables may be incorrect, but you will not be able to justify a value which is different from the market value that the exchange is giving in case the shares are frequently traded. But more often than not, all the methods should align. If it is not aligning, I would suggest you should look at the frequency of tradability. Even though by the regular formula it may look as a frequently traded stock, you may have to look at the free float that is available in the market, because there are times when the free float in the market is very low, so entire 75% might be blocked by the promoter group, and the 25% which is there in the market might also be parked with a lot of institutes, big institutes, who are not really trading very frequently. So if the actual free float is very low, in that case it will indicate that the market value which is prevalent, the value which is prevalent in the market and on the exchanges, is not really the fair value, and in that case you may be able to justify the DCF and comparable companies method valuation in your valuation report. But you will have to be very thorough with where the disconnect is before actually issuing a valuation report.
I think Snehal, we'll stop here. We'll actually move to the Thanksgiving because we are already overshot the time. So those who have questions and those questions have not been answered here, they can refer to the mail ID which Krupali has shared, and they can directly on a one-to-one basis. Is it right? It is okay with you, Krupali?
Sure, yes.
They can write to you and you can give the answers to them.
Yeah, definitely.
Yeah. So I'll request Kishore Hingwani now to propose vote of thanks.
Thanks, CA Nitin Brahmaji. It's my privilege to have been asked to propose a vote of thanks on this occasion. I, on behalf of Association of Professional Valuers and the entire team present over here, and on my own behalf, extend a very hearty vote of thanks to the speaker, Mrs. Kripali Gandhi Shah, for her presentation today on such an important topic, valuation under mergers and acquisitions. It was a refreshing webinar where a lot of concepts got revised on PPA allocation, basis of PPA valuations, importance of business valuations in merger and acquisition exercise, valuation methods, and much more. I would also like to thank CA Mr. Sanjeev Singhal for being the chief guest for this webinar. I would like to thank the organizers, Mr. Sandeep Agrawal, CA Nitin Brahmaji, and the Professional Development Committee, Sayali Deshkar, Ashmita Patke for such nice introductions, and above all, our President Ramon Bhave sir for his immense guidance and heading the value addition seminar. I would also like to thank all the members who attended the webinar today and look forward to meet you all again with a very good topic going forward, which we'll share it in all the WhatsApp groups. So stay tuned. Good evening and goodbye. Thank you.
Thank you very much.
Thank you.
Thank you, everybody. We can
Thank you,
conclude the
everyone.
session. Thank you, Krupali ji.
Thank you.
And for the benefit of audience, next time the chief guest is Joint Company Secretary of Reliance Industries Jio, Savitri Parikh. So a big shot is coming. She has hardly any time, but she agreed my request because long back in 1995, we were working together when she was a youngster. All right. Thank you, Krupali. I know your schedule is so tight because it's very difficult for a person like you. And thanks to all the audience above all, because if they are not there, then no use of any speaker or the coordinator.
Right.
All right, I request all the audience, you can get logged off. And of course, the recording is already was streamed on YouTube. And here there were 100 people full, and on the YouTube also there were a few hundreds. So the edited version we will send you, Krupali ji, and if possible, if you can send us the presentation. Then we'll circulate among the audience.
People were asking whether you will be making available the presentation.
Yeah, sure. I can share that.
Okay.
So you can send it to me, or you can send it to the same WhatsApp group in which you were added. But there your number, you have to keep it tight. Okay, send it to me. Then we will circulate. Thank you.
Thank
Bye bye.
Thank you.
Bye. Thanks.
Riddhi, you can end the session and put it for recording.
Okay, sir.
Yeah, end for all.
Okay, sir.